Well, hello. It's a pleasure to be participating in the City UK annual conference today. Amongst the themes that you have chosen, I will focus on innovation and how we think about it and assist innovation as public policy makers. And in doing so, I want to draw on our work on payments and digital currency, including an important paper on the latter that we published last week. Now, to cut to the end briefly, I believe that as public policymakers, we have to be clear on the rules of the road that innovation needs to follow to serve the public interest. But in doing so, to be clear that innovation and innovators can rightly challenge those rules and, of course, cause them to adapt. But what we can't have is a world where innovation gets a free pass to ignore the public interest. Because the odds of that sort of approach ending not well are too high. So it follows, therefore, that as public policymakers, we need to provide a lead in setting out these rules of the road and be prepared to think openly about how they can be fitted to changing circumstances. And this requires early engagement, something that we are very keen to do on digital currency. Playing catch up with public policy is not a recipe for success, in my opinion. Now, there will inevitably be elements of tough love in such a process and some disappointed ambitions, but I'm confident that out of it will come a robust form of innovation. I hope also that laying out the principles of public interest and how they should be put into practice in the context of new innovation will help to deal with another difficult and perennial challenge of financial regulation. It is in the nature of innovation and a good thing that while some ideas succeed, others, quite a few, will fall by the wayside. How many people remember Vision, TopView, and Gem? Well, I have to admit that I didn't until I did some research for today. In the mid-1980s, they were rivals to Windows for the personal computer software market. Actually, more precisely, they were briefly rivals. But as they say, the rest is history, as were these three rivals. In our world of finance, though, things can be more complicated because dealing with failures itself raises public policy issues. There are quite often suggestions that central banks and financial regulators are anti-innovation and lukewarm on competition because the results will at times be messy and the winners emerge and the losers fall by the wayside. Well, we're not anti-innovation or anti-competition, but we are trying to manage our sphere of influence in order to achieve our public policy objectives as required by Parliament and serve the public interest continuously. And with that in mind, let me apply the framework to the world of payments and digital currency, because it's no exaggeration to say that this is the beating heart of central banking. It's where it all comes together. The Bank of England's mission is to promote the good of the people of this country by maintaining monetary and financial stability. And a key way in which we fulfill this is to ensure people have confidence in the money they use, whether to store value or make payments, and that it is an effective unit of account. At the heart of this is confidence in the value of money, meaning confidence in the monetary value of not being eroded by inflation, in other words, monetary stability, and confidence in the system and institutions in which it is held and transmitted in transactions, in other words, financial stability. A useful practical definition of this meaning of stability comes from a saying by Alan Greenspan, namely that monetary stability is when people's decisions on spending and investment are not influenced by their concerns and expectations about the value of the money they are using. Now, it's possible to extend that saying to cover aspects of financial stability too. For instance, in terms of being concerned about the safety and soundness of individual banks. There are two forms of money in use in the UK. There's nothing unusual in that respect about the UK. Central bank money is a liability of the Bank of England. It's available to the public in the form of cash and to commercial banks in the form of reserve accounts held at the Bank of England. Private money takes the form of deposits in commercial banks held by the public, our bank accounts. Central bank money anchors the system. It establishes and maintains sterling as the monetary unit of account in this country. It does that by having the full force backing of the state. but it is a small part of the overall monetary system, and increasingly so when viewed through the lens of payments. The use of cash in payments has been declining for some time, and the pace of decline has picked up during the period of COVID. Somewhat paradoxically, the amount of cash in issue has not declined, and there are sections of the population who continue to rely on cash. And to be clear, we have no plans to end banknotes. Commercial bank money is widely used as a means of payment, a store of value, and for making loans in the real economy. But use of commercial bank money has come to rely on its relative efficiency, the regulation of the banking system to ensure its safety and soundness, depositor protection, and public confidence that commercial bank money can be exchanged for central bank money in the form of cash at all times. Bank deposits therefore provide a single location for both the store of value and the means of exchange of money. Payments can still be made in central bank money, but increasingly less so is that being done. Bank accounts are connected to a range of payment systems which provide the infrastructure to carry out the exchange of commercial bank money. And these payment systems are also subject to public interest regulation, focused on robustness, safety, and fair competition between them. Viewed like this, an observer could say, well, that looks like a pretty efficient set of arrangements. And I would say that this has become increasingly the case in recent years in this country. But that does not mean we should rest on our laurels and proclaim the end of innovation. New forms of digital money represent an important source of innovation. So we must evaluate whether and how they can meet our public interest objectives. And a key point here is that rather than use commercial bank money as the basis for transactions, providers of digital money would create and use their own money, or coin. And they could be issued by companies, including large technology platforms, with the capacity to scale up and grow rapidly. These are often known as stablecoins. They're distinct from crypto assets such as Bitcoin, which have no backing and no anchor to provide stability of value. In that sense, the crypto asset is not money, has no intrinsic value because it doesn't have a backing. It can have extrinsic value in the sense that people may like to collect and own them. It's like people collect all sorts of things. But that extrinsic value can be highly unstable and could be nothing. With stablecoins, there will be backing assets, and therefore they could have intrinsic value. An immediate public interest question, therefore, is what will it take for them to be trusted as money, bearing in mind that while they will primarily serve the purpose of a means of exchange, any holding of them will also be a store of value. Stablecoins have the potential to be systemic in terms of their importance for the financial system. As our paper describes, the precise definitions of meaning of systemic in this context do need further work, but it will be linked to their ability to scale up and grow rapidly and to become widely used as a trusted form of sterling-denominated payments. Any new form of digital money, in order to succeed, will need to be trusted as a store of value and as an accepted means of payment. Stablecoins must therefore promise credibly and consistently to be fully interchangeable with existing forms of money. They must be anchored to maintain confidence. And it's with this objective firmly in mind that the Bank of England's Financial Policy Committee has set out its expectations to inform the design and regulation of stablecoins and thus lay a clear foundation for sustainable innovation through the public interest. The first expectation says that payment regulation must aim to ensure that there is a consistency of expectation of value of the coins. They are, after all, money. And that underlines the Bank of England's existing payments regulatory regime and how it is designed to ensure the safety of the forms of money. And it's also, therefore, why we have to look to modify that system of regulation to adapt to innovation. The bank's view is that these objectives should include safety of legal claim, appropriate capital and liquidity requirements for the coins, stablecoins that is, and eligibility for support from a central bank during a stress, and a separate backstop to compensate depositors in the event of failure. Now, the precise regulatory model could include different applications of these features, as long as it offers equivalent protections to those for commercial bank money. So a key requirement will be to ensure that unless a stablecoin is operating as a bank, the backing assets cover the outstanding coin issuance at all times. Now, an alternative to a stablecoin, but not a mutually inconsistent one, is a central bank digital coin. Central bank money, as I said earlier, has a unique role in anchoring value and promoting confidence in monetary systems. And a central bank coin could therefore play an important role in sustaining and potentially expanding retail access to central bank money. I've discussed the public interest in the safety and security of money, but there is another very important public interest in this area, which goes to the heart of the monetary and financial system. I mentioned earlier that commercial bank money combines in one place, bank accounts that is, the store of value and the means of payment functions of money, and in doing so enables lending to the real economy. So what if these new forms of coins, stable coins or CBDC, result in a large-scale displacement of commercial bank money, which means that a high fraction of money in the economy must be backed by high-quality liquid assets rather than by loans to the real economy, more so than we see at the moment when the functions are combined in commercial banks, with this being necessary to preserve the stability of a now more fragmented financial system. Well, in that event, real economy loans could be financed instead by more expensive sources of funding, reducing the efficiency with which commercial banks extend credit. And this could lead to greater reliance on non-banks for credit provision, as some borrowers find it cheaper to seek credit opportunities outside the banking system. Now, in the paper that we published, we sketched out a scenario to try to illustrate this. Now, I should stress that at this stage, it doesn't say that the effect of this shift could be anything more than modest. I'm not making a headline-grabbing point here, because there's a lot of uncertainty around how this world could evolve. We don't know much about the likely demand for digital money yet, or about how it will be remunerated. We may, however, decide to limit the speed and scale of any transition towards digital money if it comes about, to provide greater assurance that financial stability will be preserved. Continuing with the provision of credit, greater reliance on long-term stable funding by banks could reduce the likelihood of a sharp deterioration in bank credit conditions. There could also be implications for money markets. The smooth functioning of these markets is important for the Bank of England to meet its objectives. So there are many moving parts to this landscape, and it's a complex area of innovation. I've talked so far about the impact of innovation in digital money in normal conditions. But of course, we also have to think about how it could work in a stress, where the availability of new forms of digital money could increase the proportion of banks' deposits that are withdrawn. Private liquidity insurance is calibrated to help mitigate liquidity risks. In aggregate, given existing liquidity resources, the banking system should be able to cope and withstand sudden deposit outflows. But I have to say that there is significant uncertainty around how smoothly such a deposit outflow would have unfold in a new world of digital money, emphasizing the importance that we have a system which protects financial stability, an important part of which would not only be liquidity regulation, but also access to the Bank of England's backup liquidity facilities. So I hope this brief canter through this very important area of potential innovation gives a sense of how important it is, why we must, both domestically and working with international partners, ensure we understand and respond to the public interest issues that arise here, so that we can do our job of protecting stability, but also so that innovation can happen in a world where the public interest is well defined and protected. And I can't underestimate, if this innovation were to happen, and it's still an if, just how fundamental it would be. So I'm going to end very briefly by merely listing the elements of the public interest that I haven't talked about this afternoon, just to emphasize how big it is in the area of innovation with digital currency. I could have talked about some length about our other core purpose, monetary policy and monetary stability, controlling interest rates in a world of digital money. I could have talked about competition in the financial system, about financial inclusion, about data protection and privacy. I could have talked about the potential for reducing transaction costs of international payments and transfers, very important. And finally, I cannot ignore the risks that we have to protect against it being attractive for money laundering and cyber criminals. So I hope you get a sense from this very brief, in a sense, review of the landscape of innovation in digital money, just how potentially important it is, the scale of the issues it raises, and therefore the amount of time and emphasis we're going to be putting on understanding it. Because as I said earlier, it is really the beating heart of the monetary system that we're talking about here. Thank you. Goodbye.